Okay, so we're gonna have a great panel about option volatility and a bit of trading. But first, let's start with a round of introduction. So I will start with a quick couple of words about myself. Federico, I work on the R&D side on Bitfinex, and I'm also advisor to Talex. So yeah, if each one of you can say a few words before we start.
Good morning, everyone. Pierre-Antoine. I'm building STS Digital. We're an institutional options trading platform solely dedicated for crypto. We act as principal and make markets on options on close to 500 coins, so very active on Bitcoin options, but also a very long tail of different coins. So working with a cross-section of foundations, individuals, investors, hedge funds, and also distribution platforms that use option in the crypto context. Very nice to be here, and thank you for inviting me.
Is this thing on? All right, great. My name is Faiz. I'm a founder and managing partner at Harmonic. Harmonic is a bifurcated financial services and financial technology company. We're all traders at heart, lovers of derivatives. You know, a lot of my background and my partner's background is on the floor trading in the CME, NYMEX, and whatnot. And in crypto in particular, we've only been going for almost close to 2 years now, but you know, we've been slowly building our market share in the derivative space, in particular futures, and doing some options. We also work with treasury firms, kind of helping them use derivatives for their particular use cases, whether that's getting access to capital or expressing directional views. And also just kind of building technology at the same time. You know, our core belief is that education is very key to the space, whether you're institution, retail pro. And yeah, I'm very happy to be here. Thank you for inviting me, and looking forward to a very productive discussion. Thank you.
Hi everyone, I am Gabriele, I'm the CEO of Hercle. Hercle is an infrastructure provider when it comes to liquidity and banking services for crypto brokerages, firm, market makers, retail brokers, FX, remittances, businesses, PSPs. We do trade mostly stablecoins and majors, especially Bitcoin, and I'm really excited to be here in this panel.
Great. So let's start with the first question. I would like to look a little bit what happened in the past couple of years in the market. And specifically, something that is quite interesting is that, we have an history of hitting a lot of all-time highs with Bitcoins. But usually when we were hitting all-time highs, volatility was quite high. As recently as last year, like when we hit like 73K in 2024, volatility was over 70 or maybe even touch 80 implied volatility. But now in 2025, we've been hitting a few times the all-time high and sometime with volatility below 40. So what do you think changed in the market to cause this phenomenon? So you want to start?
Yeah, no, I think there's two different phenomena that are playing. So I think on the one hand, you see definitely that realized volatility on Bitcoin has reduced, and that's a function probably of the sheer absolute total market cap, if you want, of the Bitcoin in itself. You know, it's when it was a few billion assets, it could double, triple, but when it's a multi-trillion-dollar asset, doubling would mean a huge amount of new value created. And so I think that naturally caps the volatility of the actual asset, the realized volatility. And then on the option side, on the implied volatility, which is synonymous with the price of the options that you can trade in the market, what you're just seeing is a huge flow of very motivated option sellers who are effectively just trying to generate yields, on their Bitcoin, or in some case, purely playing the compression of volatility, which tends to happen in maturing markets. So on that side of things, the generating on Bitcoin is a massive theme. This has been discussed for the last few days very intensely, and so you just see these flows of people trying to just get a little bit of pickup on their Bitcoin and hope that they're not going to get exercise on the calls that they're selling. And so this is just a floodgate, and so it means that the implied volatility has compressed massively, and so today, when people ask me, so how should we go on about doing this call overwritings? I'm like, it's harder and harder to do it sort of very systematically and blindly. You have to wait for events, a bit like what we had Friday 2 weeks ago, to then very tactically come into the market and just sell at the peak, right? But I think these are the two things that I see are the major factors.
Yeah, I mean, I'll jump in there quickly. I think it's I mean, Pierre mentioned some very good points. I also think the liquidity in the market has improved, especially in the underlying, let's just say Bitcoin, whereby, a higher price has meant, more institutional involvement. And in general, you just don't get that much movement in the underlying because the liquidity is just so much better for market makers, from just more number of market participants, right? So as Hendrik said, you don't get, as many of those volcanoes, but when you do, you're able to see, implied volatility again, then spike. I also think industrial or institutional hedging flows are playing a large part in this. As Hendrik was talking about the put-call skew, it's not very common to see an equity-like put-call skew in Bitcoin as we have in the last few months, whereby puts have just been so much more expensive than calls. Some very interesting risk reversal plays if that's what you're into. But, you can kind of dissect that and look at why that is the case, right? I mean, with the emergence of all these treasury firms, some of whom are actually backed by debt as opposed to equity, right? There's a lot of pain on the downside, right? There's a lot of pain. There's margin calls. So what we see when we're talking to clients and what we see across the market in general is a lot of them are just, long puts to the downside, right? So you kind of see the market has evolved a little bit more in the case of, and we'll get to retail later, but it's being used for a lot more industrial and institutional hedging, right? Whether it's to hedge downside or a lot of people are selling calls to the upside to just generate some extra yield on the Bitcoin they may be holding. I think that trade has been very popular, right? As far as crypto options go. So I think that has definitely led to a compression of volatility. Do I think that'll remain the case forever? No. I think long convexity is a very interesting trade. And especially as it gets cheaper and cheaper to be long options, I think you're going to find a lot more interesting plays that can be made in the market. So yeah, I think it's going to be about kind of getting in there and coming up with more interesting trades. But I love to see change in the market, right? Because it means things that used to work a long time ago stop working, kind of are open, to as trading opportunities to us as traders in the market. So yeah, that's my view on volatility.
Yeah, I mean, I totally agree with my co-panelist here. The main driver for us has been, the increase in liquidity when it comes to the underlying asset in the spot market, and for sure, much more institutional players selling volatility. A lot of institutional hedging, as we were saying, that hedging, firms wanted to get yield on BTC. I feel like especially a lot of, shitcoin VC moved to VC to a liquid fund and then to BTC only long, basically. And then, we have been witnessing a lot of players wanting just to get yield on BTC. And yeah, I believe those were drivers that compress the volatility. And I agree with the fact that, it can be, on one side, it depends on what are the view you want to express, but then it's much easier to express, to buy options and express a directional view on that side eventually.
And so, yeah, you guys already mentioned the institutional players and treasury companies. So, yeah, in a way, the way they trade it helped to reduce volatility thanks to their flow. But do you see also some potential risk that they can bring to the market with the increased leverage that they have? So, do you see a scenario where Bitcoin crash and all these treasury companies, they're forced to sell and we can have a very catastrophic cascade?
Yeah, I can jump in on that. So the answer to that is a very simple yes, right? I mean, high leverage without responsibility, kind of results in the events that we saw in 1010. But what I do see with, institutions a lot more is there are, a handful of them are a lot more responsible, right? Like I said, if they're funded by debt, some of them are actually short puts, but being long puts is a very effective way of protecting against margin calls, kind of benefiting from the convexity on the downside. Now, is it a risk the more and more leverage that you add to the fire? Absolutely, right? But I think us as options traders and advisors on derivatives all we can do is kind of educate them on how they can protect against the downside, right? And that's why options are so great, right? You can't short a perpetual to, you know, protect against a margin call that's 20 grand below, right? And that's how puts are just absolutely brilliant for that, right? So I think it's obviously, you know, down to the treasury firms themselves to be responsible with the levels of leverage they take relative to their equity. Where we can help, I think we all have a role to participate and kind of have these productive discussions and kind of, you know, advise where we can. But, you know, it is something definitely to be wary of. But I think, again, like options, that's what they're for, right?
Okay, I don't know if you guys want to add something. Otherwise,
I think it depends a lot on how the agreements underlying the purchase of the you know, the coins are structured. I think some of the big actors that have been doing DATs for a while tend to have well-structured agreements, and but some of the more recent entrants, I think, have used, you know, some funky structures, and ultimately I think also the devil is very much in the detail as to what happens if the market tanks, and how these loans to be repaid, right? Yeah. Can you actually convert them into equity, or do you have to repay with cash, and so on and so forth? So I think this is what you need to look at.
I mean, I totally agree with Pierre, actually. Here. It really depends on the contractual agreement that those that are entering into. And also when it comes to using options to hedge some type of risks, you know, then you also imply that there will be a counterparty risk with the options dealer. And the options market is still trading mostly OTC. I mean, with this Coinbase Deribit acquisition, maybe we're going to see a different type of market structure in the future. But I feel like, you know, a lot of options dealer, they are making prop market making in the books. The balance sheet are not, you know, segregated, and there is a bit of a counterparty risk involvement that can imply some type of underlying risk, which is, to me, could be irrelevant in the case that will need to be repaid. You know, get the P&L from the dealer. Yeah.
Yeah. Speaking of which, I mean. So far, option, I mean, we just saw a presentation of how amazing options are, but still we didn't see so much adoption from the market, at least not to the level that we are used to see in TradFi in respect to the futures and perpetual trading. So do you think it's that just because, why most people just are so comfortable with the perp, and there is still not as much option flows? Is it because crypto is too much retail driven, or it's because the perp is just such a good instrument? What is your view on that?
Yeah, maybe just, sorry.
Okay, as you.
Just to put, sorry, I'll do it. Just to put, like, you know, some numbers on that reality. The in crypto right now, I think the options market is, in terms of volume, is only 5% of spot. If you look at TradFi, it's oftentimes on a par or even multiples, right? Yep. If you look at equities and FX. So it's very true that options have been so far less successful. My sense is there's definitely part of the fact that it's quite a segregated, retail-driven market. And I mean, by retail, I mean just people that did not necessarily come from a TradFi background where options are actually very popular, but just kind of were successful in the early days of crypto and keep trading, but using sort of perps product, which are intuitively easier to understand, even though they come with embedded risk, as we've seen on Friday. So I think it's definitely related to that, and it's also because the perception of options is that they're more complicated. You have slightly more parameters to take into account. You have the volatility. You have all the Greeks that we discussed. So it's a combination of all these factors. But we are very much in the camp of believing that, if anything, that means we're still very early, and that the growth potential is you know, even bigger as a result of the fact that that market is still very small.
Yeah, I mean, I think sometimes as derivatives traders, we take our knowledge for granted, right? Especially when it comes to options. I think we are still relatively early. And when we say things like, you know, options are a lot more popular than TradFi, well, that didn't always used to be the case, right? I mean, prior to the early 2010s, retail involvement in equity options was really nothing. And it was really firms like Tasty Trade and Thinkorswim that came along and kind of taught retail, how to trade options from a very first principles approach, right? And I think it's going to take something very similar in crypto. I think there's a real lack of productive educational material. I mean, just go on Google and look up how to trade crypto options, and a lot of it is just on a manual on like the 5 Greeks, right? And if I'm a first-time trader, kind of looking to get into upside trading in crypto, I don't know what a Greek is, right? So I think it's going to take a little bit of shift in focus on how we're trying to make retail get involved in this market, right? As Hendrik got into, you know, the upside in this market is very substantial, right? But it's about kind of helping retail take their opinions and formulate those trade opinions into trades, right? In a very simple and constructive manner, right? A very simple way is like, this is what Tasty Trade is, like, are you holding cash? Yes. Do you have a stock that you particularly like? Yes, right? Go, you know, buy the stock and sell some calls against it. Now, there's a lot of, you know, option gurus on Twitter that will tell you that, you know, that trade wouldn't have worked for the last 10 years, but we're in a historic debasement bubble, right? I mean, you can do the opposite of that trade. You can sell puts and kind of, you know, buy the underlying as it sells off. So there's a variety of ways that you can kind of get or drive adoption in these markets without having to kind of teach retail about, you know, all the Greeks and their second order derivatives, right? I think that's been the approach a little bit of, okay, you can't trade an option unless you understand everything about it. But, you know, let's look at Polymarket for a second, right? What is Polymarket? Polymarket is a binary options platform, right? And it is perhaps the best UX in retail right now for retail. For crypto. So I think it's going to take ideas like that, structured products, kind of, you know, constructive UXs to help drive adoption. And I look forward to seeing more of those kind of platforms. I think we have a lot of exchanges now. I think I would like to see some more useful tools and educational material to drive adoption in this market.
Yeah, I feel like it's a lot about how the market mature and the demographic. Perpetual are much easier to trade for retail. But now regulation, you know, is coming in, especially in Europe and US as well. And you know, when you're selling options or perpetuals to retail, it's a matter of regulation. You know, in Europe you need to be MiFID compliant or whatever. And so we need to see the growth also of multilateral trading facilities that have this type of regulation and can offer actual products to retails. On the other side, Polymarket is the best example. I mean, Polymarket is selling. They're not doing that much volume at the end of the day, but they're selling binary options to retail, and they found a sort of gray area where it's really easy to do that. And this will definitely, you know, increase the adoption when it comes to the retail side, as maybe Robinhood did for the equity options, right? On the other side, I see the development of structured products such as Vault, you know, cash secure put, this type of product that. It's much easier for a retail to understand. Basically, just put either Bitcoin or, you know, USDT there, and then you get yield. And this type of nuanced marketing, let's say, can drive better adoption on that side. So I feel like platform like Talex, where you also can do much more sophisticated trade, can be helpful, especially for the seller and the market makers to keep offering new products. I've been witnessing a sort of growth when it comes to also, let's say, certificates for high net worth individual, such as capital protected Bitcoin exposure, like this type of stuff. I mean, Switzerland is a great market for this product, and so on the high net worth individual side, there has been this type of growth. Yeah, I mean, bottom line is, as you know, the more the market matures, even in terms of structure, as I was saying before, in terms of counterparties, etc., the more I believe the options market will grow. I feel like it's growing a lot in the last year, as massively growth, especially OTC. So a lot of volumes we're not seeing there. But yeah, it will keep growing. I mean, perpetual until someone was speaking about Bitfinex before. You know, in 2017, even as a sophisticated player, you were just doing basis trade and doing triple-digit returns, right? So it didn't make any sense going to exotic product or non-linear. Now, you know, the market is a bit more efficient, so even the exotic player, the sophisticated players are going much more on the exotic, you know, line of the product. I mean, big investment banks are entering the market, selling to derivatives, selling to retails. You know, it's like Unicredit in Italy selling structured product on BTC ETF to retail, you know? And so I feel like we are going to witness a massive growth on the option side.
Nice. And yeah, do you expect that? So we already mentioned the October 10 event. So do you think that in a world where, like, in a market where options are much more widespread, that kind of event could have been prevented or not been as bad? And do you think maybe also it was maybe a wake-up call for many people to have a bit more sophisticated hedging strategy?
I'm not sure about that. I feel like that event was mainly on the altcoin side, and on that side there is someone is doing optional altcoins actually as a STS maybe, but I'm not sure it could have been prevented, especially because it was more mechanic in the sense that exchanges with their market protection mechanism or ADL and etc. Have impacted a lot the liquidity, which is not that thick when it comes to altcoins. And so I feel like the general growth of the market increases the liquidity, so for sure the volatility will compress. But I feel like, especially on the long tail asset side, I don't believe the volatility will change that much, because I don't believe the liquidity will change that much actually at the end of the day. And so yeah, I mean, when it comes to Bitcoin, for sure. In fact, it was not a massive event for Bitcoin. Actually, we've been seeing much worse event in the past. But yeah, so that's my take.
Yeah, I think definitely people got a wake-up call on that day. I think and this is something we've been saying actually to our clients for a while. It's don't forget when you're entering into any perps, whether you're short or long, that you're implicitly taking a short volatility view on the market, and so you're basically short crash risk, which or like huge rally risk, right? But in any case, you're short a very, very high, sort of very specific short volatility move. And definitely from our conversation, this was maybe something that the market needed, and I think we very naturally some conversations for us with some of our clients reopened, and I think sadly it wasn't a great advert for the perps market, especially for the institutional crowd and some of the hedge funds, which are sort of looking at how do they position themselves on, for them, that pretty esoteric derivatives market for crypto. But I don't necessarily think that if there had been more options traded, the event would have been sort of less volatile. I think the perps market will still remain massive, and so and at the end of the day, will still remain a synthetic market, right? It's like it's really just you need people on both sides of the trades. There's not really like an underlying price or value, so you can see punctually price falls to zero, especially for altcoins on those perps market. That's going to stay. I think that's a feature that will not move for now. So I just think it showed that options are probably better to from a risk management perspective, but I still think this type of event can happen in the future on the perps market, I think, yeah.
Yeah, I mean, I agree for the most part with my co-panelists. The only thing I will add is, it's a very hypothetical question, right? Hindsight is 2020. It was a very, right tail event, left tail event, depending on how you look at it and how your P&L went on the day. But I think, let's just kind of run with this for a second, had a lot of the speculation in the market, the speculative open interest in the market, been in options as opposed to perp, where ADL was rife across the market. A lot of people got ADL. They didn't know why or how. Some people didn't get ADL. And we were doing a lot of reverse engineering using the data we have from Hyperliquid. And a lot of it was, kind of sketchy. I think you don't really get that, with speculative options. Like Hendrik said, is you don't get whipsawed out of a position. You're going to hold that to maturity. And at worst, okay, your premium goes down, but you actually get to see out the position, right? And now if you look at the very quick recovery, relatively speaking, from the lows, a lot of people have been damaged as a result of perpetuals, right? I think this is a very negative press event for perpetuals if you really look at it. So I think moving forward, this is a prime opportunity to kind of introduce people to options and kind of let them protect themselves, and then moving forward now. Whether altcoin options emerge as a widespread tool in the future, we'll see. There's a lot of people trying to push it. But as a speculative tool in general, I think, I would say, like, if you were to replace a lot of the speculative open interest, and if you want to kind of play with the idea of replace it all with options open interest, things would have been different for sure, right? You wouldn't have these dodgy ADLs. You wouldn't have a lot of these things that happened that people kind of got burned by. A lot of it was retail. And if you keep burning retail, at some point they just pack their bags and go home. They're not going to just keep losing money. So I think, we have a responsibility here, most of us being institutions, to kind of push this agenda and kind of just keep educating people.
Yeah. And now we are looking to a world where there will be more flow towards options, but with more flow, we also need more liquidity. So what do you think are some of the main challenges when providing liquidity to the option market compared to the perpetual market?
I mean, the simplest is a fragmented order book, right? There's 100 different strikes with 100 different expirations. It's a tech-heavy operation, right? Whereas for a perp, and this is why it was just so easy for new players coming into this space, you write a Python script, you can in the early days, very comfortably make markets in a perpetual. So I think it's a tech-heavy lift. I think that's why also the RFQ market does very well in options, because it's very customized and people can act on a view, even in the absence of formed order books for what they want to trade. But I think a lot of people are doing good work in this space as far as technology goes in options and making markets. But I think this is very much a work in progress, right? I think in order to have lit books all the time, we're always working with Alex and kind of seeing where we can help there. It's going to need people taking this market seriously. And once they kind of realize that, the edges, which have been greatly eroded in perpetual market making because it's just so competitive, right? If we can kind of drive taker flow more so into options, which is what it's going to take. I mean, if you have lit books all day and there's no educated flow or any flow coming in, people are not going to want to make those markets. So we have to kind of create a synergy of, real adoption. And then also, when there's real adoption, there's real flow, you're going to find the market makers are going to start, putting up books and taking advantage of that flow. And you'll then kind of, get a real market.
Yeah, when it comes to real adoption, I see, industrial use cases growing when it comes to miners, hedging, that hedging, even cross-border payment flow, the needs to hedge, participating forward this type of product, especially if BTC is going to be used as a global settlement asset, as I personally believe. On the other side, when it comes to challenges, I feel like collateral management and counterparty risk, I'm gonna double down on that again, but I feel like it's really key, which actually is a derivative of fragmented order books at the end. But yeah, we were saying that dodgy things happened last week when it comes to ADL in Hyperliquid or Binance and etc. But that's much more a matter of the actor rather than the instrument. When 3AC blew up, Deribit, actually didn't margin call them, right, if I recall properly. So there wasn't actually a problem. So it's much more about collateral management. How can you settle with exchanges? Counterparty risk and etc. And I believe even structured players such as actually they are entering the big Chicago firms, the big HFT firms, so then they can easily bear that tech heavy lift. But yeah, so it is much more about to me much more about market structure, reliable players such as Talex and counterparty risk basically.
Yeah, and just maybe to complete. When you think about what a liquidity provider has to do on the option space, with the central limit order book model, I think it's important to realize that you have a range of coins, you have puts and calls, you have the maturities, you have a huge amount of strikes, and then you have different venues that are offering central limit order books. So it's a 5-dimensional matrix, if you think about it, of order books that need to be tradable and for which the liquidity provider is ultimately on the hook. If a few of them are not really adjusting to a particular move in the market, you have an army of very smart, lazy hedge fund that will just hit you and you will lose money, right? And so the central limit order book in options, in our view, as a liquidity provider for options, has reached or reaches its limit fairly quickly. There is a reason why, for instance, Deribit, for all its might, hasn't really managed to offer great liquidity to its client outside of BTC and ETH. Try to trade Solana options in size on Deribit, and you'll quickly hit those limits. And it's just the sheer amount of order books that need to be populated and sort of like watch over, you know, like fire, like milk on fire, right? You have to pay a lot of attention to that. So that's very difficult. And so from our perspective, and this is a view we've had for a while, and we've actually built our platform for this, for altcoins, you know, can be major altcoins, can be really long tail, but for altcoins, we think the market is, RFQs are actually going to become more and more relevant. If you think about the FX market, that's actually how most of FX market options are traded. It's an RFQ model. You specify which pair, which strike and maturity, and then a syndicate of dealers is basically giving you quotes and size on which you can actually trade, right? So that sort of like solves that central limit order book issue for liquidity providers. And we think a combination of both, of, you know, CLOB for the majors, for BTC and ETH, and then RFQ for the more risky stuff is probably the way forward.
So the last topic I would like to touch on is on the role of DeFi. So do you see it as like that it's going to keep growing, or the intrinsic limitation on its efficiency that it can provide, or like the risk of regulatory capture in the future, it kind of like limit the growth that we can see in the DeFi markets?
Yeah, I mean, I think we've gone from one extreme to another a little bit, whereby it was hard to do anything in DeFi. And I'm sure a lot of early players are very annoyed because they were basically hunted down by Gary Gensler and put out of business. You know, with exchanges like Hyperliquid and, you know, Paradox and whatever kind of coming up right now, it is a bit of a KYC arbitrage. I'm a huge fan of DeFi and decentralization in general, but I think, you know, it might get to a point where we're trying to do too much too quickly, right? And if you look at every single bad event we've had in crypto, it's because people are trying to do too much too quickly, right? Hyperliquid yesterday launched equity perps, right? And they just renamed the NASDAQ to the XYZ 100. We're like, okay, cool, and that's the way around the regulations now, I guess. So I think we have a responsibility, again, not to do too much too quickly, because, again, that just sets the market on fire. FTX tried to do too much too quickly. You know, there's a bunch of hacks where people didn't take security, you know, seriously. And this is just a regulatory version, right? So you have to respect the rules of the market where you operate. And it'll only take, you know, a bunch of US investors hopping on Hyperliquid, getting burned on ADL. Imagine getting ADL'd on a NASDAQ future, right? And the complaints that will come from that. And then people will start taking seriously. And who knows what the next administration in the US is going to be, or what the political landscape is going to be. But I think as innovators, we have a responsibility to kind of be responsible as well, right? You're doing new things that haven't been tried. And, you know, ultimately protect the users and the consumers of your product, right? We all try to do that as much as we can. So I think the role of DeFi moving forward, I would like to see a little bit more responsibility in consumer protection, especially given the, you know, events of 10/10. A little bit more accountability would be nice, rather than just saying, "Oh, you suck, you got liquidated." Like, that's not, you know, I saw that more than once. This is exactly how things are supposed to go. That's not how things are supposed to go, right? You're not supposed to get, you know, blown out of positions unfairly and whatnot. So yeah, I think responsibility and accountability is going to be really important for the future of DeFi, because the innovation is already great. I think there's some great products out there.
Yeah, when it comes to DeFi, especially Hyperliquid, was the the best player when it comes to derivatives. I feel like it's just a regulation arbitrage right now, and as every arbitrage will close down at some point. Let's see when. When it comes to options in DeFi, I feel like it's really tough to bootstrap a market, you know, in DeFi, especially even for capital efficiency. You know, the good trade-off is that you don't have counterparty risk, but on the other side you have not great capital efficiency. And so I believe that sophisticated player would not go there. I mean, there are solutions even to trade BTC options on-chain on BTC, right? There is DLC markets and those guys. It's really capital inefficient. If you want to liquidate and etc., it's not the best, you know, the best way to do that. So I feel like it could be a good distribution tool using like vaults and this type of product for retail. They want, you know, again, yield on stablecoin or some, you know, collateral. And so productize using, leveraging the DeFi setup and atomic settlement to productize solution for retail. It's a good solution. I don't believe that, sophisticated players or in general massive volumes will be traded when it comes to options on-chain. Yeah,
I think, you hinted at it, but on-chain options have historically suffered from quite a few drawbacks. And you talked about the capital inefficiency because you have to post full collateralized option if you're full collateral if you're short option, and sometimes over collateralized. And then for a dealer in the back, you just can't really net, your exposure and your margining with all of these individual smart contracts, right? So that creates this real capital inefficiency on both sides, on the dealer side and on the taker side. These are still very real issues. And then you also have these issues around how do you price an option, right? Like, can an oracle, or do we have oracles that are actually able to feed live the volatility surfaces for long tail assets? No, like not yet. I mean, that's something that can be solved. I think it's just that it's so early that we don't have, there hasn't been this kind of coordination within the whole options ecosystem that oracles are able to do that just yet. So you see that sort of those structural issues within the DeFi market for options, which remain to be solved. So that being said, there's been examples of protocols that use, let's say, an on-chain UX, right? So it's permissionless. You can access it, you access it like you would access any other DeFi protocols. You get access to vaults, you can generate yield for yourself. And in the back end, the hedging and the providing of the actual yields or the convexity, if you just want to go long, are sort of like settled, on a sort of off-chain kind of basis. So I call it like a hybrid model. So you get the benefits, of DeFi for the permissionless nature. But there's still a big element of CeFi in the back that is not always obvious for the users.
Yeah, just to touch on this point, I totally agree with Pierre. You say DeFi distribution because it's a regulatory arbitrage. By the end, the protocol is hedging with a centralized market maker. And so at the end of the day, it's just a reg arbitrage to me.
Okay, great. So I would like to give the opportunity to the audience to ask a few questions. So, yeah.
Thanks for this. You guys mentioned that there's a lot of institutional activity and see the retail as the solution for more volume. But I heard nobody talk about what's happening in the real real markets, like corporate demand, world trade, so that drives volumes. Of course, they don't need all this sophisticated stuff. It really starts with plain, stupid forwards. So how ready are you guys to serve real trade, like the stuff we buy, the companies which produce it?
Well, I think the corporate demand, and there is a big element of corporate demand in options already. So if you think about, all the treasuries of all the foundations, I know this is still very crypto native, but this is very much a corporate need.
Are miners considered corporate? No. And then
real economy, the stuff you wear. Real economy, the stuff you wear, the stuff you eat, the energy you buy.
Yeah. Okay. So I feel like related to BTC options in particular, I feel like a use case could be I really believe that Bitcoin can grow as a global settlement asset to settle cross-border payments in size. And I do believe there would be, it's the most liquid asset at the end when it comes to crypto. You can settle almost instantly with Lightning Network, so it drives a lot of advantage when it comes to cross-border payment. And if you think about liquidity, it's one of the most liquid assets against FX in every jurisdiction. So you are going to have some sort of structured products that will help. You may have a supplier paying in BTC, and and the buyer that wants to hedge, or the other way around, right? Actually, the other way around. but so I do believe there will be a growth in the structured product when it comes, especially to cross-border payment to settle, the global trade. So that's the use case that I see personally.